frame. This is gold. And we have annotated for this before. I think we've been showing this here a couple of times that we've been on with you. That, you know, we went into the end of Jan very strong. We had a little bit of a warning with a blow-off volatility to 5.6, but pretty much you were trending all the way along here from our September, end of August, September break, which is the same time now. So it's kind of ironic, just a little seasonality point to plant as a seed here. Tail end of August, here we were, and we call for that breakout. So we were once, twice, three times a lady at 2K, saying it was going to 3K at around the 3K level. Again, August, going and break, run all the way up, 5.6, the absolute high. Trended into this point, then we sold off. That was first impulse. Second impulse was a long bloated one, a bit of a heartache for precious metals fans, especially the silver guys. Lots of selling coming off. Of course, Hormuz, the oil started to take precedence over precious metals. A lot of surplus nations were rolling their excesses of net imports by America into gold. So the deficits that the US was running was leaning to the gold run. So hence the war actually got those surplus trade nations focusing on their energies. All of them are energy importers. So they then had to focus on oil, and depth of inventory on energies. And that ended up, being a long bloated second impulse into the lows. But what you can see technically, a little bit of a buying up wick on that hammer. It started again, another hammer, and then another hammer over here. We thought we would be up and running. And then there was a little wobble, and then we kind of got frozen in just up north side of the 4K level, and a week before last, we were saying we think midweek, the following week, we'll be breaking out. We had a beautiful little, on a much smaller time frame now, there's that 4,000 mark. You had the upside HVF structure, which is what we focus on. It's very light, very, very good breakout pattern. I can't recommend it enough. And of course here, instead of just trading the pattern to the target that was suggesting a 4,300, we were aware that the small pattern is breaking us out of the larger pattern, the falling wedge. And the first in a new trend always has overperformance. So we stay long. You might just about make out that there's a channel in here. We call this an overperformance trumpet. And it particularly applies on first setups in new trends. So you keep long technically until such time as you either fall out the lower part of the trumpet channel, or if you break out the top, we wait until you return and cross back in. So we close there. So if you're going to hyper perform and break out, we only close on the return into the channel. So that's the methodology, a little bit of what we do in terms of trading the gold market. It's been absolutely fabulous for us. And I just, for, authenticity's sake, we really do play in the markets. These are entries here on one platform that we've carried over. I have closed those now. They were all around 4043, 51 and 53, different platforms as well. We trade this all the way across, and it's been a very, very profitable entry for us, as you can see, across different platforms. So I'm hoping those that do a little bit of trading, I hope you know what you do. First of all, non-advisory, have also enjoyed it. But for the rest of us that are just also blue pot investors, and, we didn't sell silver or gold throughout this coming down. In terms of unleveraged, we don't sell, we're net accumulators, because the big game hasn't yet happened, the grand reset of debt and fiat. Although I think you might be taking us into those weeds when we talk about recent events with Besant and the JPY. But yeah, that's, I suppose, my opening salvo on, a very pleasant and a profitable period for us.
What stands out about this current move is who isn't behind it. Retail investors aren't the ones piling in. Analysts point out that this rally has been driven overwhelmingly by central banks and large institutions, not the wave of individual buyers usually seen near market tops. That distinction carries weight, since retail participation tends to get labeled dumb money, capital chasing momentum only after it's already run. This time, with institutional and sovereign buyers setting the pace, some analysts argue the move carries more staying power, even as the data shows the general public remains largely on the sidelines compared to earlier gold cycles.
For us, this 50s, you would say 54 probably on silver was your localized low, and those 39, 54s on gold were a localized low for us. There's just one. There's some people that have gone completely, I hesitate to say a little bit too crypto for me, in terms of predictions and timings on precious metals. I want to warn that there's a real debt-based potential crisis. I think you might want to talk more about that, so I'll not say too much on that. But that's a wild card that can see everything get sold in margin by the same institutions that are currently metals buyers, by the way. And most of this precious metals move as central banks and institutions. It's not excessive retail participation. That was happening here near the highs. Sadly, retail are like dogs that chase cars. They really want momentum. They don't know what to do if the car's stationary. We're not, the retail engagement here is far lower, I would imagine, than the retail engagement was over there as a percentage. And even still, the price makers are the institutions and the central banks and the nation states, I suppose. China would be probably qualify as a price maker and chaser at the moment. Yeah, so I come back. Sorry, I get the gist of the question again. What we're actually saying is we feel that's a localized bottom. We leave a door open for an exceptional event that could lead to, and it's the kind that would be a headline event. Subprime, the spill from $1,003 down to $698. CV19, you had silver fall to, I think it was 11. Or 14, I can't quite remember at the absolute low. Technically, I don't think you could buy it at that level. You might get that, but outside of that, let's say 10%, 15% possibility, we feel this is a localized low. But you also, following on from that, we don't want to just go, you're just going to go ripping. This doesn't have unbelievable volume, and there has been some pushback at the end in both wicks so far. You can tell by the weightiness, the degree of volume. This is a good working off a low move to put you into mid-range. It's not escape velocity for new highs before Christmas, I don't feel. I think we're going to finish in the larger range between the previous high, 121, and, the low of 55. I would say that's your 60% probability. The chance you go beyond, maybe 25% on the high side and maybe 15% on the downside for the remainder of the year. So for people that are just asking where we're going to be come Christmas or mid-December, the markets usually slow down a little bit. They can sometimes move a touch. I would say in range, which is the previous high and this as localized low. I would give you my 60% number in there, Elijah, in terms of silver, which can be quite good. You can be at 82, you could be at 77. I think it's generally going to drift and be more buoyant than heavy outside of that wild card regarding debt and a major demand destroying event, which is building. It has to be.
There's a growing concern worth naming among market watchers. Some of the largest holders of US government debt may not actually be free to sell it. When Japan needed dollars to defend its currency and looked to offload treasuries, it was reportedly offered swap lines and repo facilities instead of a straightforward sale. Similar arrangements have surfaced around Gulf state currency pegs and years earlier involving a major US pension fund caught in a cash crunch. Critics argue this exposes a market where genuine price discovery, one where sellers are welcomed as readily as buyers, has quietly broken down, replaced instead by mechanisms designed to keep large holders locked in place.
Andy's bang on the money as usual, and he's absolutely right to make that observation. In fact, we've done a whole Substack post on this very concept. It's called the fallacy of market cap. Technically from 1 year to 30 year, so excluding durations below than a year, there's a 24 plus trillion market cap of US debt out there. However, the liquidity at the price that they're attempting to retain is surprisingly low, and there's an asymmetry. Price discovery mechanism is when sellers are as welcome as buyers, and we've coined the phrase, when you're a big holder of USTs, it's almost like the Hotel California. You can check out anytime you like, but you can never leave, and that is very much the feeling here. So there's not just the example of Japan being volunteered to utilize a repo system. Hey, we gave you 1.2 trillion. How about you just let us get out and get our 1.2 trillion back, or whatever we can salvage that the market will allow? No. We don't want you doing that. Why don't you take a loan? It's very expeditious in terms of that, and that's why the phony narrative of the US coming to help a friend. No, it isn't. A problem for Japan that holds your asset becomes your problem if they're going to try sell it, and you then have to give them alternatives to access capital. That's an explainer, and it's kind of a softer version of BlackRock and Blackstone's closing down the private credit market. Again, we'll come to that one later, I'm sure, but it is a sort of a soft version, and I want to highlight it's not the only example. Swap lines were rushed out for the GCC states, the Gulf states, during the loss of tourist revenue, during the loss of oil revenue following bombings and the Straits of Hormuz attack vector. And they too sit with a peg for the Riyadh against the USD, and they were not having tourists, not having attendees. People were selling apartments once they realized there's 2 weeks of food and water there, and then everything else needs importing in. And they were selling, getting their Riyadh and wanting to turn it into dollars and leave. That's not very helpful for a peg, which has to be held up. So the Saudis wanted to sell USTs, and it was like, no, swap line time. And then, of course, there was the California Teachers Fund, which I recall and remember a couple more years back. Many people won't know, but one of the largest statist pension funds couldn't make a payroll, and they wanted to sell treasuries. And very quickly, the US jumped out and said, no, we're writing new clauses in to our mandate. You're entitled to take a loan against the T's. So this is not a single event. This is a line item. It's very much once the hand has gone through the hole, it doesn't come back out. And that doesn't point to true market price discovery. This points to Ponzi establishment. I joke that there was a micro crypto formed called Hex, where all the buyers were encouraged to bring their friends and buy the token, and they were all encouraged also to stake it, so that for 15 years with huge penalties if you unstaked it, with compounded 39% plus reward, 5,555 days, which is the better part of 15 years. So you essentially get buyers in, and then you ensure they never do any downside damage to the market cap. And they successfully ran that market cap on that token to 77 billion, which is now 99.9% down. And that was the founder knew and understood the concept of market cap, and even was quite open about explaining it to those that participated. You see, it's worth a lot if none of us sell. Well, yes, but every now and then you have to get out, and that means selling. And so I think we actually have the micro crypto event in a much larger scale in terms of USTs. And this is incredibly bullish gold. It's not very bullish the future of Western economies and the crash that goes it. And we must be careful about being excessively gleeful about our gold bags going up, because it's actually not our gold bags going up. This is still the same, silver ounces that it's always been. It's a story of a debt-based fiat collapse, which is how we've started so many of our presentations with you. You are in a debt-based fiat collapse. The yen is going down and the rates are going up. Milkshake theorists have often said, the US rates will go up and then the dollar will appreciate because money will all be coming for that better yield. No, that's not how it's transpiring. Debt and fiat are very similar things. Fiat is money today. Debt is, hey, have it in a year's time and I'll pay you a rental agreement for a year. That's it. Otherwise, they're the same thing. You can't kill debt without, in the longer term, killing fiat. They can diverge for short periods, but on the long haul, no. And you're seeing if the Japanese sell their treasuries and then repatriate their money, which is a little bit of an inverse carry trade, a reversal on the carry trade. You saw how damaging it was to the 10-year, the 30-year, and how quickly it became America's problem, and they were there to help Japan with other facilities. Well, why not just give them the money back? Why not let them to sell it? Well, we don't want that, because the market can't take it, Elijah. The difference with Japan, and many people say, oh, Japan's even more indebted, they're worse off. Unfunded liabilities, Japan goes from around 230% to 330%. Unfunded liabilities in the US, you go to 550%. A lot of promises that aren't going to get paid. By the way, the UK is at about 400%. They just crossed 3 trillion in pounds on their deficits, and their specialists there, the Taxpaying Alliance, so this is not beat up on America, this is state of the world, calculated that if you took their atomic waste cleanup commitments, pensions, state pensions and everything, and put it on the balance sheet, the United Kingdom would be closer to 12 trillion, putting them at 400%. So they're not a whole bunch better than than the States are. But the point is, this is a Western fiat and debt-based collapse, and that's why we have weak currencies and climbing rates. And that is why, counter to everybody's opinion, increasing rates are supposed to be bad for gold. In truth, if it's a preservational matter and a loss of confidence matter, and our theory is there's a vertical line from 2020 August that said the game changed here. Nominally, bonds were trusted and were going up, and we're even in a blow-off bull market as you went into CV19, so 2019 into its peak. Once you were past the halfway mark on 2020, we call that's a turn, that's the final turn, and we think that's a 40-year end in the bond bull market. In that same year, we called the end of that. And I keep reminding people of this, not for plaudits or ego. We get so much wrong, just like everybody else. It's so important, because many people, when I see the YouTube comments and the responses, yeah, but we'll just print, we'll just do. No, money gets borrowed into existence. Somebody else has to take the other side and be happy to take a debt instrument for the new money to be created. That's called the T-ledger, assets and liability. If nobody wants to hold new debt, then you don't get to borrow the same amount of money into existence, or you have to do it at a much higher interest rate, which means debt is faster devaluing, which means assets that were bought, Bank of America bought 500 billion at 1% of USTs, suddenly lose huge fortunes. They're about 85 billion down at current rates. That's a massive hole in a bank's balance sheet, by the way. So these are the consequences of the rising interest rates on collateral, housing, and so many other things. And that's where the notion that, no, but we can just print. No, really, actually you can't, because rates have to go up if nobody wants to hold the debt instrument.
Shifting away from gold, some analysts are sounding alarms over the enormous borrowing wave tied to AI data center construction. Their concern, these facilities are partly being financed through opaque corners of the private credit market, with insurers and reinsurers reportedly tapping policyholder premium reserves to help cover the build-out. Since much of this activity falls outside standard disclosure requirements, critics warn it mirrors the hidden leverage that built up ahead of the 2008 financial crisis, only this time running through corporate balance sheets instead of consumer mortgages, and backing computing hardware that can shed most of its economic value within just a few years of being installed.
The private equity got involved in private credit, and that's two very dangerous words, especially the word private, by the way. That's probably should be translated into opaque, don't ask too many questions, and maybe offshore in certain circumstances. What has clearly been happening is there's an imperative for excessive expenditure, which doesn't necessarily even have an economic return in the hyperscaling data center building. And this is like a subprime bust build out. Only retail is not involved. Instead, now you're dealing with B2B. It doesn't involve us so much. It's mega corporates building huge data centers, and the tenants are chips. that die in 3 years or lose their main economic advantage in 3 years, and in some cases 18 months, as the tenants that need to earn income during that period to pay the mortgage on the establishment of the data center and the water, the electricity, and the heating that all surrounds their creation. So I call it the surveillance grid build out, because it seems non-economic. It seems designed to bring the very reset they want to introduce the debt and digital money that they're so after bringing, for which the data centers will then be part of that grid. So that's how I see them squaring it off. And I think we're going into a debt-based collapse of intent. It is, and it's a very serious set of circumstances that runs far deeper. It's far more opaque. In fact, there's even been different laws. There's been loopholes written post 2008 in terms of collateralized debt obligations. There were certain laws introduced. They've created a circumvent loophole for data center based debt as well, I was reading today. So I mean that's it's intentionally destructive as far as I'm concerned. It's ask no question, don't ask too many questions here. We're allowed to do what we're allowed to do. We're the adults, and we've decided that this build out takes priority over all things. And insurers, premium floats have been used as capital originators for investing into the private credit that have gone lockdown, that you can't withdraw, and reinsurers have even got involved. So that's the B2B of insurance. You buy a car insurance from Geico, for example. Geico has too many cars maybe in that state. They want to lay some of it off. They go to Aon or Marsh, which is big corporates that B2B risk. They spread the risk of the book. They'll sell you a bit of car risk. They'll take a bit of hospital risk to have a more diverse portfolio. And that's typically what goes on. Now, even the reinsurers that get huge premiums from individual retail insurance companies to carry some of that risk are now taking on some of this. So this is all very opaque. We don't get to see what's on their books until it blows up, until somebody has to make your car payment, Elijah, when someone hits you from behind and the company says, actually, we're only good for taking premiums, we can't settle claims. There's a delay. We've got liquidity issues. You go, well, why would you have liquidity issues? You've got your premium floats that have been coming in all the time. Oh, well, we made some bad investments in it. What did you invest in? Oh, it seemed the guys from Goldman Sachs and BlackRock sold us on this high-yielding credit, Oh, and what was that being invested in? Now, data centers in, and so the story unfurls, and we find out that once again, they've socialized the cost, and then they'll lean on the insurance industry's general cover. So if one insurer fails, all insurance companies typically pay additional premium as a slush fund to protect against one of them being weak or having done some fraud and being worse condition than they declared, so that the whole industry doesn't get hammered. So they will then put so much stress on that fund that it won't even be sufficient. So then you need a government bailout of the insurance industry's fund, and that's how you get dilution of fiat. It all gets put into your inflation number, and you have crisis, you have layoffs, and a lot of things, and the socialization of the cost of that excess investment gets put on you in the end.